Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for May 8th, 2022. I hope you guys and gals are having a great weekend. Last week was an extremely busy week. We have a lot to talk about with the Fed meeting, also with the Bank of England, with the RBA. Price action was extremely crazy. So I'm going to jump right into it because I think there's a lot to talk about. Now, let me get into the charts. I actually have something that's on my mind that I really want to talk about because we are obviously embarking on an interest rate hike cycle. And a lot of people look at it as being very aggressive. And, what's happened today is obviously different than what has happened in years in the past. We have to keep that in mind. Today's situation that we're dealing with in today's market with inflation, with the massive amounts of liquidity, the way the market's going to react to rate hikes today are probably going to be different than the way they've acted in the past. But history can sometimes be a guide, and sometimes I think it's important that we take a look at some of the probably most important things, like what moves the market, and interest rates would be one of them. And I want to take you to this chart. I'm gonna actually overlay. Interest rate hike. The last time we went through an interest rate hike cycle, which was back in 2016, you can see, well, it's the end of 2015, and the Fed started raising rates. Now, again, different time, but we are now raising rates. We're in that new cycle, and a lot of people think that rates are going to be, getting towards 3%, maybe higher than where we went in the last cycle. But notice what happened with the stock market the last time in 2015, 2016. When the Fed raised rates, the markets came down in anticipation of that. Once rates started going higher, the stock market started moving higher. All right. Now, I'm not going to sit here and tell you that the stock market is going to bounce at current levels, but it's something that we should take note of. A lot of times, especially for those of you that haven't been in the markets for years and years and years, what happens a lot of times is people say, okay, well, the Fed is raising rates because the economy is good. The economy can handle it. And then the market interprets that as, okay, we need to be bullish. And that does happen quite a bit. Matter of fact, if you look at the last rate hike cycle back here in 2004, post the dot-com bubble, if you will, the markets grinded higher as the Fed was raising rates. Now, you can see when the market started moving lower after that, the Fed cut rates. Obviously, this is the great financial crisis, and you can see COVID was another situation where the market got a little ahead of itself. The Fed started lowering rates. We were trying to make sure that the Fed was trying to make sure that the economy stayed propped up, and then all of a sudden COVID hit. The Fed dropped rates again. So if history is a guide, the one thing that we should note is that as rates go higher, it doesn't necessarily mean that stocks are going to move lower. That's the important takeaway from today. So I hope you guys and gals understand that. And you can go back through history and see other cycles as well and what has happened in the market too. So with that being said, let's look at stocks because, the obvious, and I'm going to go over to the daily chart of the S&P. This is obviously, I'm looking at the broad market of the S&P. You could do the same type of analysis in the NASDAQ or the Dow or whatever you want. But I do want to point out that we are at and are holding really critical support in the S&P around the 4,100 level. That is key. A lot of people are very bearish because of this head and shoulder pattern. All the headwinds that the economy is facing. I get all that. And I think the market is obviously trading heavy as well. But the one thing I want to point out about technically is if you look at the S&P, you can see how the S&P has diverged as far as relative strength goes. So what does that mean? Well, we might be a little oversold here and, strength is not increasing as the market is moving lower. And that could allow for us to get a little bit of a rebound. Now, if you follow along in the daily F.A.C.E webinars, that we have this head and shoulder pattern, but you also have heard me say this, that the head and shoulder pattern, to be symmetrical, right? To be, to have good symmetry, you could say it somewhere around here. We probably have another couple of months to build out that right shoulder. So if you're getting really bearish down here as stocks are at the 4,100 level, I think what I'm showing you is have a little bit of caution at these levels. The one thing I also have to point out, when you're talking about the S&P, is you got to take a look at the dollar index. The dollar index is very strong. Yes, it is. But we're also challenging those recent highs from 2017. We've been above them very slightly. And as you can see, just at the end of the week, we hit new highs. Relative strength was divergent, meaning the dollar moved up into new highs, but not as strong. Now, you'll notice that I have this blue line drawn right here. That's the 102.50, maybe 102.30 level. That is you can see that dotted trend line between the 2017, I almost said 2017 high, the post-COVID spike higher in the dollar index was in 2020, and that connected the lows right here that we had posted this last week. Comes in right around 102.50, 102.30, depends on how you want to draw it. And we all know that now the dollar index, in my opinion, is consolidating, trying to figure out if it's going to break higher or lower based on, what we're seeing here. So, obviously if we break below 102.30, 102.20, that's going to be a bearish event for the dollar. If we break back above 104 and we really get a good move and solid daily close above 104, that's going to be a very bullish outcome for the dollar index. Now, what could happen next week that could push the market in either direction as far as the dollar goes? And what is happening next week that could really push the dollar higher, not higher or lower, but I meant to say the stock market higher or lower? Well, it's the inflation data. We have CPI data coming in this next week. I think inflation is expected around 8.1%. Remember, the last reading we had in inflation data was 8.5%. Markets are expecting inflation to cool a little bit. And if inflation cools a little bit, that will take some upside pressure off the Fed for being so hawkish. So what I'm trying to say is the inflation data could really, really move not only the dollar, but also move the stock market this weekend. So if you think that there's going to be a breakout in the dollar or a breakdown in the stock market or a breakout, or a recovery in the stock market or a breakdown in the dollar, probably Wednesday is going to be the day that we see an extension lower in stocks or a recovery or an extension higher in the dollar or a bit of a pullback in the dollar going into later on next week. So this week's inflation data that happens on Wednesday is going to be vitally important for the markets, in my opinion. And that's why you got to be a little careful getting too caught up in being too bullish or too bearish at the beginning of the week. That doesn't mean that we can't move, but the real risk is going into next week is that data. Now let's talk a little bit about we had the RBA meet last week, and the Aussie rallied and off of support. Well, actually, let me take that back. We didn't quite hit the key support. I was thinking that we'd drop below 70 cents. Post RBA give us an opportunity to be a buyer down here below the 70-cent level. Didn't happen. And what we did is we actually created a higher low in the Aussie dollar. That means that support around the 70 cents level is really finding a lot of buyers down here. If we get below 70 cents, that's obviously going to be pretty bearish for the Aussie. But as you can see, it's trying to stabilize. The 200-day moving average right here is going to be very, very important resistance. That comes in around 73 cents. Support is around 70 cents. I would venture to guess by the time we get to the CPI data coming out of the US, we're going to be somewhere mid-range, maybe above 71 cents, maybe closer to 72 cents, somewhere like that going into mid next week. Okay, so that's the Aussie. Let's also talk about the sterling. The sterling got absolutely clobbered last week. The Bank of England came in way, more dovish than the market was expecting. The MPC members were, just the commentary was very dovish, and the sterling broke lower. We broke below this weekly 618 retracement. Now, if you listen to the F.A.C.E webinars every day, the commentary that you've probably heard from myself or the rest of our team has been, hey, the sterling is supported but the euro's already broken below the spike lows following the COVID spike down, and that would be right over here in the sterling. So the sterling is doing a little bit of catch up, and you can really see it in the euro sterling currency pair. If you want to see how bearish the sterling is, just take a look at the euro sterling, and you see this massive breakout of this channel that we have been following. But the point I want to bring here is we are below the weekly 618 Fibonacci retracement. We're approaching levels we haven't seen since 2020, and obviously look at the RSI on the weekly chart in the sterling. We are very oversold. The daily charts are divergent. That means you shouldn't, or actually be a little careful chasing the sterling lower now that we've broken lower, but as we had expected to break lower, but we just relative strength is starting to diverge. So you got to be a little careful. And this might have more to do with the dollar index than the sterling alone. For me, if I want to play the dollar on the short side, meaning buy sterling, buy euro, buy Aussie, buy, doing things like that, I might end up choosing a different pair. If I get really bullish the dollar following this week, let's say the inflation data is really strong, then perhaps the sterling has some further weakness ahead of it, maybe closer to 120. So that's how I'm looking at the sterling right now. Now, I didn't talk about the Fed, but the one thing that I have to mention about the Federal Reserve is that they are hiking rates, and it looks like the path of least resistance is going to be higher for a rate hike. Now, before I get into, I wanted to show you a little bit of gold, and I wanted to share with you Bitcoin. Let me just talk to you really quick about the sponsor of today's webinar. So do me the favor of listening in. First of all, it's sponsored by us, Forex Analytics. If you haven't tried it already, make sure you do so. It's only $1 for 10 days to try it out. Jump in our community. We have probably one of the most active communities in the markets. We are chatting all day long, around the clock, throughout the trading week. It's only $1 for 10 days. You get to try out the premium version, even if you decide to stay with the light version. Download the mobile app because you get the mobile app with the light and the premium version both, but you get to try out the premium version while you're on trial. Also, check out the trader funding program. If you guys and gals think you're a really good trader, but you just don't have access to more capital, well then check out the trader funding program. And maybe you even do have the capital, but you just don't want to invest your own money. Well, trade ours. If you think you're a good enough trader, then take the assessment. The assessment is a very small fee, but if you pass the assessment in a demo environment and you make 10% without having more than a 5% maximum trailing drawdown or a 4% intraday drawdown, then if you can make 10% on a demo account, then you can access our money and then keep 75% of the profits. But if you want to watch a video on all the specifics, there's a 2-minute video at the bottom of this page. It's called the Trader Funding Program. You'll see the video of me. Just click on that video. It's 2 minutes. Watch it. See if it's right for you. It's a great option for a lot of traders that don't have access to larger amounts of capital. All right, back to the analysis. So I wanted to talk a little bit about gold because we had been focused on gold moving a little bit lower towards the 200-day moving average. We didn't quite hit the 200-day moving average, but for those of you that have been following my analysis, I've been looking at a Gartley pattern that looks like this, and I was looking for a reversal, down at the 200-day moving average. But you'll notice that this little spike low down here might have satisfied that move, and from here we could move higher. I think if you're watching gold, you're probably a little bummed out that it hasn't rallied, especially with the higher inflation. But let's not lose sight that if you look at a weekly chart, gold is actually quite bullish. We've been holding up very well. This is a cup and handle pattern for those of you that aren't following it. We've talked a lot about this last week, and we talk about it actually all the time, but it is something that we have to keep in mind that gold is still holding up well. It's probably going to also move following the CPI report later on this week. But the last thing I really have to talk about is I have to talk about cryptocurrencies, because cryptocurrencies, as you guys know, especially with Bitcoin, we're really critical support here. Did I just skip that? Yeah. Okay. Here we go. Bitcoin. Let me make sure I'm on the right chart. I thought I was on the right chart, but let's get over to, I think I had another Bitcoin chart up here. Here it is. Okay. So this is the Bitcoin channel that everybody's looking at. We are actually attacking that channel support over the weekend. As I'm speaking right now, you can see in a live environment, we are actually sitting on this really critical support. Now, when you're on a weekly chart or a monthly chart or a daily chart, you got to give it a little bit of room for error, because trend lines, or let's just take that back, technical analysis is not an exact science. So what I mean by that is we might be really close to support, and we might even be breaking support based on what your lines you're drawing. But you have to be really careful. It's all about an area. So right now we are in a very important, quote unquote, area of support for Bitcoin. You know, if stocks rally, Bitcoin is probably going to follow suit. And later on this week, if the stock market comes under pressure, I believe that Bitcoin will be under pressure as well, probably targeting closer to that $30,000 mark later on this next week, if we see a breakdown. Obviously, everybody and their brothers, mothers, uncles, monkeys, sisters, nephew is looking at the 20,000 breakout point. Because everybody's looking at that level, it's you know, we might not even make it, because everybody's trying to target that level. I would assume myself and everybody's brothers, mothers, uncles, nephews, monkeys, sisters, stepbrother, and sister are going to be trying to buy Bitcoin at 20,000. So, you know, chances are we are not going to make it all the way down there. Plus, I think those of you that watch Robert Saylor and MicroStrategy will see where his stops might be. But, you know, Ethereum is a very similar story. We're nearing major support in Ethereum. Probably comes in around the 2,500 level. Those are levels that are going to be very important to the market as we get into this next week. So just remember, join us over at Forex Analytics. Make sure you're listening to the free F.A.C.E webinar. The link to that free daily webinar, if you wanted my current views and also our updated views in the market, you know, you can listen to that free every day. And by the way, if you are a European or an Asian trader, we've got really big news for you this next week. So make sure you tune into the F.A.C.E webinars to get our big announcement. It's a huge one. It's going to expand our services, and I'm excited to talk about it with you guys live on the F.A.C.E webinar. Have a great weekend. Enjoy the rest of your weekend. If you like this video, make sure you give us a thumbs up. Subscribe to the channel down below so you don't miss any of the week ahead videos. I'll catch you guys on Monday. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.